Hi, I'm Ajay Tyagi. I'm part of the equity investment team here at UTI, and I follow the growth style of investments. Today, I shall take you through some of the tenets of my investment philosophy. The value of a business in its most fundamental sense can be derived by considering the value of cash flows that the business generates over its lifetime, and then discounting them back to the present date. Implicit in this assumption is the concept that businesses should generate more cash than what they consume, and therefore the net cash generated, also known as the free cash flow, becomes the source of economic value and ultimately wealth creation for its shareholders. If you were to check the history of long-term wealth creators, you would realize that the common attribute that all of them held was a strong free cash flow generation. Why I emphasize more on cash flows than profits is because many companies can have strong accounting earnings, though they may be having poor cash flows. But as explained above, the real source of value creation in a business is its cash flows and not accounting earnings. Therefore, focus on cash flows builds in a margin of safety in picking winners and multibaggers. Quality signifies the ability of a business to sustain high return on capital employed, called ROCE, or return on equity, also called ROEs, over a long period of time. Truly high quality businesses are those that are able to generate high ROCs and also high ROEs even during difficult times for the industry or sector, and therefore operate above their cost of capital at all times. More often than not, a business with high ROCE or a high ROE shall be able to generate strong cash flows and therefore generate economic value as explained earlier. Growth, on the other hand, signifies long-term secular growth for businesses. I like businesses that have steady and predictable growth trajectory and where long-term drivers for such growth can be understood with higher certainty rather than having cyclical or unpredictable growth. While high-quality businesses create economic value, a high-growth business enables compounding of this economic value. It is for this reason that my favorite hunting ground for stock selection is the intersection of quality and growth. Such businesses are very rare, but my philosophy is to stay focused only on such businesses, even if it means not finding a new idea for many quarters. Bottom-up signifies focusing on the underlying economics of a business as the key stock selection framework. Under this framework, we try to focus on the fundamental attributes of the businesses like its growth prospects, industry outlook, margin profile, competitive dynamics of the industry, cash flows, ROCs, etc. For a true bottom-up focused approach, the role of macros is really very limited and in fact insignificant. Since I follow an undiluted bottom-up approach, I focus all my energies on evaluating the businesses, albeit with different prisms, to build a robust hypothesis. As a corollary, the impact of inflation, interest rates, fiscal deficit, etc. is very limited in my investment approach. I like investing into a business as if I'm a part owner of the business and hence would be holding it for a long period of time. Once your investment framework is aligned towards investing into a business rather than investing into a stock, the relevance of macros and cycles reduces considerably. As mentioned earlier, my starting point is to establish the quality attribute of a business. In other words, businesses with high return on capital employed and high cash flows are the ones which are preferred. At the same time, predictability of the business is very important in my framework as I like to understand how the business would look like in a few years down the line. It is for this reason that businesses with poor or average ROCEs and a cyclical characteristic are the typical businesses that I like to avoid, which basically means that businesses with commodity kind of attributes like metals, oil and gas, construction, etc. are usually avoided. On the other hand, a lot of consumer-facing businesses across sectors like banking, consumer staples, pharmaceuticals, and autos are the ones where majority of the fund holdings would come from.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.